I would like to discuss 3 topics in 3 minutes. The big view, key disruptive factors, and finally a focus on credit. Financial returns this year are mediocre and we're not surprised. What's remarkable is that despite the many idiosyncratic shocks, flash crash, trade sanctions, new Italian government, risk-free bonds have struggled to benefit. That is because inflation is rising and central banks are normalizing policy, especially the Fed. We keep an underweight in govies. Equities continue to beat bonds on a rolling 12 months basis, but the gap is shrinking along with economic confidence. As we get closer to late cycle, equities should be favored over fixed income. Credit spreads tend to turn before stocks. The switch from equities to bonds is unlikely to happen before 10-year yields in the US reach 3.5%. That will be danger zone. In all, we retain an overweight in stocks, but an even smaller and defensive one. Also keep the overweight in cash. We tactically reduce our duration short. Fundamentally, the trade war is the major risk. That will remain a focus into the US midterm election, but risk there now look more balanced. We're a bit more concerned about European politics and the Italian budget this autumn. At market levels, we'll be watching 4 areas of risk. From the least to the most threatening we have. Oil prices. We're not losing sleep on it because growth is now less sensitive to the oil price. We still like to be long inflation. 2, dollar strength has emerging market ramification. We see limited upside, however, for the dollar given the twin deficits and the mature cycle. 3, as the Fed enters more restrictive territory, financial volatility will increase. 4, the US high-yield market is very stretched, and this is worrying given the record leverage and rising rates. Euro credit spreads have widened but remain low by historical standards. Spreads are still negatively correlated to bond yield. That's a nice diversification benefit, but that relation has become asymmetric as spreads now trend wider. Not all sectors of credits are equal. Look at spreads from a historical perspective since 2000. Dollar high yields appear very rich. EMBI is relatively cheap and to a lesser extent, Euro investment grade. Reassuringly, longs in Euro credits have been reduced. Euro financials are cheap, but they are exposed in the near term to sovereign stress. We underweight financials, but plan to reverse that call into year-end. We have an overweight in Euro non-financials. That's it for today. Good investment. Speak to you soon.